So I think this week, TCSS, I saw there's quite a long list of questions. I will go through all these questions. I think some are long, some are short. And then I think the one that we will discuss more, I think should be the talk about the FAANGs, because just in the past week, I think we have quite a number of earning release from the FAANGs companies. For example, like Facebook, Google, Apple as well. So if you guys have any questions, we can of course go into more details on these questions later. But let's start from the first one, because I think Boon Song, he will be able to stay for a while only. I'll start from the first questions now, okay? Buffett says that if his portfolio is small, he's sure to able to generate 50% return. What is this 50% return method he taught about, how to go about it? I know, Boon Song, you have prepared some write-up, right? I think for those who don't know, you can go to the Telegram group and click on the message that Boon Song just shared. But since you are here, so I'll pass the mic to you to comment on these questions.
I've read a few books from Buffett in recent years. So there are a few reasons why he said that he will get a 50%. So one of the things he did is he had the information advantage, which you arguably would say that he doesn't have right now, because back then there wasn't the internet, there wasn't computers to screen stocks for you, but he was willing to do all the hard work of looking at all the S&P and Moody manuals. So he was looking for very cheap companies like Western Insurance, which was selling at maybe single digit, way less than single digit PE. Bond Maps, who had an investment portfolio of $65 per share versus $45 share price. He was also very intelligent, so he was able to see from the perspective of many parties. So, for example, this Rockwood deal where the one of the owners was asking to tender offer for stock in exchange for cocoa beans. So the value of the cocoa beans would give shareholders a $36 value. You could easily buy the share at 34 and trade it in for $36 of cocoa. So that $2 over 34% will give you a 5.6% gain or some sort. But he held on for 560%. You can go on to read the attachment that I put in the chat. It's quite lengthy. So the other reasons why he is able to get that kind of gain is because he put compounding of his capital first ahead of maybe pride or ego. He was willing to coattail or copy other investors. Some people might not think that this is a big deal, but really we are human beings. We are emotional, so sometimes pride comes into play. Another point that I think that he's able to get at 50% is because he's willing to do all the legwork for stocks that are very thinly traded, illiquid stocks. One of the examples was National American Fire Insurance. Back then, the so-called the owner, the majority shareholder, owns 70%, whereas the rest are scattered among farmers and all that. So he had a partner to do all the legwork for him, going around buying stock quietly, and in the end, he managed to accumulate 10%. And lastly, he's a person who is very willing to concentrate capital. Probably about 30% of his shares were put into ideas such as American Express, Bond Maps, and way before he set out his partnership, he was willing to put 3/4 of his net worth into Geico. So it's not something that most of us even now can do it.
There's a question here. Did he really say that 50%? I remember
Sorry?
he have some quote. He quoted before, I think in one of the
he did.
Okay, okay.
During one of the AGMs for
Yes.
Berkshire, somebody actually asked how should he invest if he has small sum of money, and that was his reply. He said he could guarantee the person 50% per year. But one thing to understand is that 50% a year is not a nice 50% a year. You could be talking about maybe 0% this year and then 200% the next. The returns can be very volatile.
Yeah, because in the past he was able to generate so high return is because the market valuations in the past, there are period that market is quite depressed. Hence, I think it's possible to generate that kind of return, and he did, right? the thing is currently we are still in consider, although interest rate has went out a bit, but still quite low compared to historical periods. So and market valuation isn't that cheap as of now. So I wonder, like, okay, is this 50% still applicable or not, or is it like we have to adjust down because the market valuations is considered much higher compared to decades ago?
I suspect he will still be able to do it because he will definitely look at areas where you wouldn't see. Yeah. Most of us are preoccupied with ideas that are popular. He wasn't. He will be willing to go and look for very obscure stocks. So that small amount of money, even if you look at maybe the what they call that, Russell 200, 2000, this morning actually pass you a screen cap of some stocks that return like 100% year to date, and we are not even 2 months in. Yeah, so maybe he'll be looking at stocks that are as small as this.
So thanks, Boon Song, for the comment. So I think my comment on this is that I remember he said that, I don't remember he quoted 50% or some of the numbers, but I trust Boon Song on this. But the key point here is not about the return. I think what he was trying to say back then was that Berkshire will not able to generate 50% because given their size, right? Their size now is a couple hundreds of billions. Once your size is a couple $100 billion, there's limited things that you can do. So for example, the stuff that Boon Song just mentioned, for example, like arbitrage, these kind of things, you can find all these opportunities, but they are usually smaller scale. Because the opportunity, let's say if the scale is very big, the arbitrage is very big, someone else could have seen it. So usually it will be arbitrage away as the size become big now. So that's why if you have a size limit, meaning that he can't go below that, so the number of opportunity is very, very limited for him. But if you invest a small amount of money, say only like, let's say 10 millions, right? You actually, the opportunity, there's still a lot. In fact, as of now, if you go into, let's say, Singapore exchange, right, and you look for all these arbitrage opportunities, I think they are still there. It's just that it requires certain amount of diligence. You need to can go into the details, know about the risk, because all this risk is not just like risk-free kind of returns. Because first, it is very small, and then secondly, you need to know what are the stuff that you are missing out, because the size is very small. Other people's with much better resources, they don't care about it because they can't enter also. And those who care about it, right, they're having small amount of money. They also won't post all these result publicly, right, or their research publicly. So it's very hard for you to go and dig stuff up. You have to go into the raw data yourself. You need to do the research yourself, and there's a lot of work that is required to have this kind of returns. I think Boon Song pointed out that the first thing is the arbitrage, because that one is considered very low risk. You get the profits fast. I think that's the good thing about arbitrage. Other than arbitrage, it will be like you take advantage on a very low valuations. And these low valuations is also possible usually at the small cap, because the large funds don't bother about it. They saw it, they recognize that, yes, this is underpriced. They can't go into it. Because the moment they go into it, pour hundreds of millions into it, they can't really buy it at current price, because the price will shoot up anyway. And once they bought it, it's very hard for them to liquidate also, because the market is the instrument is not liquid enough, right? So there's a lot of problem for the big funds when they operate at a small cap. That's why all these inefficiencies still appear in the smaller cap now. So I think for as an investor, I think we shouldn't look at the return and say, okay, because Buffett said he can do it, then we also can do it. It's not like that, It's more like we need to make a choice. Like, should you go into all these small cap, do the deep research, and then just go heavy into it, take a concentrated positions? I think that's one way to do it. In fact, people who do this, right, it is expected that they get much higher returns. But you also need to be mindful of how much effort and how much time you're spending on doing this. Because say, for example, you say, okay, you have the knowledge, you have the time to do it. But let's say if your portfolio is only 50,000, 100,000, 150,000. So how much money can you get by having this kind of returns, right? So it's better for you to spend more time to increase your active income and then make your portfolio size bigger. It makes more sense to invest, say for example, in S&P 500 and get a 10% if your portfolio is very small. But of course, if your portfolio is, let's say, like 500K, 1 million, 2 millions, and then you actually have the free time to do it, of course you can go for all these things. So I think this one is really for each of us individual investors, is that we need to position, like we need to choose our approach and see whether it makes sense or not. But of course, like Boon Song just shared, if you really can do the research and like, for example, like find out all these arbitrage opportunities and then try to arbitrage on the valuation, which is the value investing part, or go find all the net stocks to invest so that you have very low risk and you can go heavy into it. All this, right? I think you should be expected to be compensated for all this. That's I'll agree on that. It's just that be mindful on the effort, the time, and so on. So that's my comment.
And the liquidity. If you buy a lot of this kind of illiquid stocks, right, one day you never know, there's one incident in your life, you need the money and you can't sell. So I also have quite a lot of illiquid stocks, and sometimes when I think about putting in more money into such kind of stocks, I do think about what if I need the money urgently, and I'll be a bit mindful.
Yes. I think this one really you need to try it out to fully appreciate what Boon Song just mentioned about the liquidity. Because I also bought all these small cap before. It's like sometimes you can't even sell it. There's no trade, no volume, you know. So it's very hard. You can only queue it there and then just wait. So it's very hard now. So allocation is also important, because if you can see, okay, maybe a portions you go for all these like broad market index, and then maybe like let's say 1/3 you go into all these illiquid stocks, so that you know that if you need the money, you can liquidate the liquid portion first. I think at least that one you can plan about it. But the liquidity is something that is very hard to manage, because it could be that it is a semi-liquid stocks, but during crisis, when you need the money, and then suddenly the liquidity dry up, right? So I think this one also you need to go through the cycle in order to understand like what does it mean by liquidity. So need to be mindful on all this. There's a lot of all these details that just reading the theory you can't appreciate it, but you have to try it. Then you go through the cycle, then you will understand about it. So I think that's I think good topic to discuss this one. Yeah, because we didn't discuss all this often in my channel. We covered mostly those, you know, like the popular stocks. I think this one, when you go into arbitrage, right, I think the first thing that you will notice is that if someone talk about this, right, is that the company that the person mentioned, usually we never heard about it. If I heard about it, right, usually you should exclude it from this category already, because if I know about it, because I didn't pay attention, right, if I know about it, it must be something that is hot or popular, right? So I think, yeah, it has to be something that only you know and other people don't know. I mean, that's the criteria. Okay, thanks for the questions. Let's move on to the next one. Is Tesla Megapack really the next big thing? Will their California factory producing Megapack run at full capacity this year? Who are their main competitors? I'll just look around, because I saw that there's a couple of you here that I think investing in Tesla. So let's say like Jay or Gavin or Mark, you want to comment on this? Okay. If no, I'll just give a quick comment. Because actually, when it comes to the Tesla Megapack, I didn't pay too much attention into it. I just know that they have sold to, I don't know whether it's government or a utility company is in Australia. I think that's one of it. But the rest, I really didn't pay much attention to it. But your question on whether it is a next big thing or not, I think I'm a bit skeptical on this. The reason is that if we look at their financial report as of now, right? Actually, I can pull it up, because since I have it here, if you look at the financial, the shareholder deck that Tesla provided, right? You just look at the total revenue. Say, for example, the most recent quarter, they have 24 billion of total revenue. But if you look at the automotive revenue, right, it's already 21 millions. So you can just minus here, and roughly it's about 3 billions of revenues come from non-automotive segments. I think mostly these are the energy storage and so on, which include the Tesla Megapack. So one thing to note is that 3 billion per quarter, that's about like 12 billions per year, right? This is very, very small amount relative to the Tesla market cap. So I would say that as of now, it's really, really small. So whether it's big big thing or not, I can't say for now, but I would say that energy business is very small. Even if they grow at much higher rate as compared to their automotive business, it will still take quite a number of years until the energy business become big now. I think that's one thing to take note. Secondly, all this Tesla Megapack, I think they're still relying on the battery. And if you look at the auto segment, right, I think the bottleneck is still on the battery. So I think that's why whether you look at the battery or you look at the Megapack or you look at the auto business, since the constraint is the same thing, right, which is the battery. If they can't scale the auto business, means that they can't scale the Megapack as well. So I think there's some bottleneck there that is affecting both segments. I believe that is why this energy storage business can't ramp up as well, because say for example the Megapack, there's certain margin that they can take there, and auto business there's some level of margin, or they just have to allocate their battery onto the auto business for the sake of competitions. Say for example, if they are slow to ramp up their car business, some other companies will take up the market shares and so on, right? So they have to be mindful on that as well. That's why I would think that when it comes to Megapack, I don't think we should be that bullish about it, at least for now, talking about 1-2 years thing. But of course, whether this thing can be like, 10x, 100x in the next 10, 15 years, I don't have that much of insight there. I think this one is really, you need to study the unit economics of the Tesla Megapacks versus their competitions, which when you ask about the main competitors, I don't have much insight to share on that now. I'll just stop here, see anyone of you here want to comment on my comment. If not, we move on to the next questions. Why did everyone seems like keep talking about CyberTruck, saying it's everyday car? What is so special about it? CyberTruck, again, Tesla questions. Anyone want to comment on this? Okay, no, again, I'll comment. Actually, I think when it comes to CyberTruck, whether it is very special or not, I don't think it is very special. It is just a car. It's not like really a special car. I think one thing that is special or different about CyberTruck is just the design. I'm sure that, let's say, for example, like Model Y, when Model Y just launched, right, you saw a Model Y on the road. Sometimes you are like, hey, is this a Model Y? Because it looks a bit similar to Model X, because it's taller, it's like taller than the normal Tesla. And sometimes you look at it, it's like, oh, is it a Model 3? Because in terms of their design, especially the front part of the design looks not that different compared to Model 3. So when Model Y came out, right, I believe, especially for those who didn't follow Tesla, let's say just a layman just looking at the car, they can't differentiate Model Y versus Model 3 versus Model X. So I think there's not much like differentiating in terms of the appearance, the exterior design, and so on. But when it comes to CyberTruck, right, you saw it on the road, right? It's like from far you can tell this is CyberTruck, because the design is so much different. It's very different compared to average Tesla car, and it's so much different compared to just any other car. I think the design itself is just standing out, right? I think this is something that will be quite different. That's why I believe once they launch it, right, and you start seeing CyberTruck on the road, right, I think they would, at least in the first month or so, people will keep taking photo and just share it on the social media and so on. I think this one, at least, it serves as a purpose of creating more, publicity and media attentions for Tesla. I think that's definitely something that is positive for Tesla. But when it comes to the quality of the car, I actually don't think it is that different. Of course, if you look at US market, I think US market, if I remember correctly, in terms of statistics, in terms of like model, best-selling models, right, it is not a sedan, it is the F-150 pickup truck, right? I think that's for US, they really like big cars. So the pickup truck is something that they favor a lot. And now CyberTruck get into this segment. I think this is something that they try to compete on this segment. Is something that make people exciting. So I can definitely relate to that. It's just that whether the car or the design or I mean, you just look at the spec and so on, whether it's is very different or not, I don't think it's that crazily different. You can say that Tesla Semi is totally different segment. I think that is really different. But when it comes to CyberTruck, I just think that other than the exterior, I think they are just like not too different. But publicity is always good. That is how they get the publicity without spending a lot of money on advertising. So that's Tesla. People say the auto sector don't make money, but ask them Ford first. 1910s, 20s, 30s, 40s, what is their profit? No one can answer. Anyone knows? Well, I think this is a good comment. Actually, I also don't know. But for sure, if you say a company don't make money, say for example, if you pull out the Ford numbers from 1910s to 40s and the profit margin average to be zero, I don't believe that. Because if the margin is truly zero, I think all these companies, they will just go bankrupt and I think that's the situation. But when they say don't make money, I think I can clarify a bit here. I don't think the so-called don't make money is that every company's zero profit margin. I don't think that's the case. I think when talking about auto sector, two things to mention, which I think very hard to like these two things very hard. I think most people will agree on that. The first thing is for auto business is very hardware intensive. So it's physical hardware and you require a lot of capex. I think this one is true for all auto companies, including Tesla. So meaning that they have to build the factory and so on. You cannot compare, let's say, Tesla or Ford versus Microsoft or versus Meta, right? Or versus Google. You cannot compare one because one is truly like mostly software. Another one is mostly hardware. Of course, you can argue that Tesla, there's the software component, which is true, but still you cannot just avoid talking about the hardware necessary. When they need to ramp up the production, they really have to build the gigafactories, right? This one you cannot deny it. If you deny this one, it's like why do they need to open up new gigafactory? Why not just stick with one gigafactories, right? And just continue to scale out. It's just impossible because of the physical. I think that's one. Secondly is the competitions, because I think the thing that I think Buffett also talked about it is that now you are looking at Ford and let's say if we pull out the statistic and you show that actually their profit is not bad, which is possible, right? But there's a bit of survivor buyership, survivor bias here, because in the past there are like hundreds of auto companies, but there are just too many of them, just can't compete and just go away, just bankrupt and close shop. So it just shows that the competitions is crazy in auto industry. I think there are a couple of industry that's also similar. Say for example, like airlines, you can fit into the same one because they are more commodity than differentiated products. So airline is one of them. What else? Actually, oil companies also same. Say for example, oil companies, if you can't produce oil at let's say like a cheaper cost as compared to your competitors, you are just going to like bankrupt. That's just the fact, because oil, why should people buy from you at a more expensive price, right? So there will be a market price. So if you can't produce at a cheaper price, meaning that your competitors, those that can produce at a cheaper cost, they can just undercut you in terms of price, and then you just bankrupt. As easy as that, because it's not differentiated enough. This is very different compared to those companies or product that has moat. Say for example, Apple, they can charge more expensive, and I can tell you, their customer, maybe some of them will just run away and go and buy Android phones, but there will be enough customer that will stay with them, and they can just go through that hard period, and they can like raise the price and doesn't see their revenue drop a lot. So companies like Apple, they are differentiated enough. It's okay for them to raise price. But when it comes to airlines, when it comes to oils, these are just more like commodities. Then the question come back to the question that you asked here, right? Which is Ford or auto business. Is it really differentiated enough? I think this question you really need to ask, because I can't say that there's a clear answer to that questions, because on one hand, I have friends who say, oh, I just bought a BYD car. To me, I think Tesla is a good car. That person, my friend told me, he recognized that Tesla could be a better car, is cooler and so on, right? But whether he's willing to pay that premium to get the Tesla car, his answer is a clear no. So which is fine, right? So he buy a BYD. I think that's definitely confirmed, like how to say, a very logical and reasonable kind of reasoning to say, okay, there's a premium there. I'm not happy to buy it, so I go for BYD, and I'm a happy customer of BYD. So just looking at this, right? Just I won't say one friend represent the entire market, but I will just say that if you have enough people to make this kind of decisions, that means the product is like not differentiated enough. But at the same time, I have friends who pay the premium. They know that Tesla is more expensive, and they bought it, and they are happy customer. So that's why I would say that, okay. So for certain group of customer, they are happy buyer, but for certain group of customer, they are just more like price sensitive. And then whether Tesla can increase their profit margin to 20%, 30%, it really depends on how differentiated it is. You want a company that can raise the price up like significantly from now and still able to keep their customer. And if they are able to do that, I can assure you, like easily, Tesla 2 trillion, 3 trillion, 5 trillion market cap isn't a problem. If they can like just price it like for same, let's say, mileage and so on, just using their software, they can be differentiated enough that they can price, let's say, 10, 20,000 above the similar segments, and customers still buy their cars, right? I think it's easily like a super profitable companies. But of course, if you ask me, I'm a bit like try to like debate with myself, meaning that I think there's some differentiated factors in there when talking about software, but whether it is as good as Apple, as of now, I am skeptical. I just have to say that, because one thing that we can draw, I mean, one data points that we can draw is that now you can see that their demands has reduced, and they still have to cut the price, right? If it is truly differentiated enough, I don't think they have to cut the price. Yeah. So that's my take when looking at this price cut as a data point to look at. But of course, these things is not stagnant one, because even if you talk about the software, I don't think the software is like completed as of now. They're still perfecting their software. Their competitors also doing the same. So it really depends on who can come up with better products over the next 2, 3, 5 years, right? So whether their battery is good enough and so on. So those are the things that you should pay attention to, see how much R&D they put into it and how much they can perfect their products. Say, for example, Apple, today's iPhone is very different compared to 10 years ago. Why is it so much better? It's also because the R&D that they put into it, how much focus, product-oriented kind of management, focus on building a decent product that they can sell to their customer. I think these are the things that drive long-term success, and not really like just looking at as of now and see whether they are good or not. Because ultimately, EV industry is still very, very new. Unlike, let's say, like PC market and also like, let's say, smartphone market, these are matured markets. There will be less R&D put into this market because the growth is limited. Whereas for EV, right, because it's still new, and then all these companies, they still have very low market share. They're going to take a larger market share from the ICE segment. So there's a lot of R&D put into it to make the products better. And so I still think that whichever companies that can really like, come up with better products, they can still win. Not necessarily Tesla. I think Tesla could be one of them, or it could be another companies. So pay attention to that. That's why, I mean, when it comes to investing, it's not just focus on looking at past and now, right? We should also try to understand their culture and so on, and try to see whether in the future they can, keep at the forefront, like still leading in terms of the products. Okay, I'll stop here. I think long answer from me. Anyone want to comment? And whether you agree on what I just say, disagree, agree, can just comment. Okay, if not, let's move on. Would you buying any China shares? If yes, which company you're buying or monitoring? Okay, this is specific. This is asking me, so I have to answer. Answer is no. I haven't buying China shares for quite some time already. I still hold my Tencent and Meituan. I think these two companies I'm still holding, but in terms of monitoring, actually, I did look at, I mean, at least looking at the financial statements and just glance at it. I would say that for Meituan, I think they are doing relatively well. I mean, the based on the most recent quarterly earnings that I look at. So I think in terms of growth, they are still doing very well. And then in terms of the profitability, I think they are cutting costs or whatever. I don't know what happened behind the scene. I didn't read into very details, to be honest. But at least just based on the surface number, they are progressing well now. But I really screw up on this investment because I'm referring to actually both of them, Tencent and Meituan, because I went in too heavily at the first place, and I bought it at a very high price level. So for those who know my average price, I mean, by the way, you can dig up my old videos. I talk about Meituan. There's just 1 or 2 videos that you can dig out, and I mentioned about what was my purchase price there. So it's still much higher than today's price. So still not making money, but I'm still like holding it and just you can call it back holding. I don't mind. Just hold on to it, and as long as the company is doing well, I'm not too worried about these two companies now. I think they are still very dominant in their area, so that's most important to me now. Which company that I'm monitoring? Actually, I sometimes still monitor, for example, like Alibaba, JD and JD and Pinduoduo. These companies I don't pay too much attention to it, but sometimes when people mention, when there's news, I still read about it. I think still very competitive when it comes to e-commerce now. Then other than that, let's say companies like Baidu, I know they are quite good at, let's say, like autonomous driving and their AI. I didn't pay too much attention to it, but for those who pay attention to, like China AI development and so on, maybe you can dig up some good things from Baidu. I think that's one of them. Then others, I think China-wise, I would say just in terms of macro, let's say, because now they already open up, and on the real estate also, they're trying to, like come up with like, policy that help out with the general economy. I think they are still on this recovery trend. But whether it will be a straight line recovery, that's something that I think I wouldn't say is a sure thing, because anything to do with economy, sometimes there's just things that people can't predict. But at least the opening up, I think, is good enough for, let's say, if you are holding to all these stocks, I think just hold on to it. Should be good. Unless don't have to worry that they're all going to die because of the lockdown, right? So this headwinds is already gone. And the real estate things, I think, given them enough time, let's say if you just look 2 years, 3 years down the road, I think China, they are able to resolve it. That's my feel based on their policy. In the past, they have this track record of, mess up with certain sectors and then just take the time to, like sort out and improve the situations and guide the sectors and so on. I think China have this habit, and they have the track record of not breaking things. So I think that's good about investing in Chinese stocks. Yeah, not much comment actually, just comment based on whatever that I have. But to your specific questions, I don't have much to contribute here. FAANG stocks still can buy. I think let's pair with second questions here. Seems that Apple, Tesla, Google, Microsoft, many others all designing their own chips and ask TSMC to make it. Is it will affect NVDA, AMD in the long term? Oh, okay, sorry. These are two different topics. Let me just break it down first. Go for the FAANG stock first. I think FAANG stocks, right? Let's look at their financial. I'll just do a quick one. So let's say if we look at the quick one, I think just before we go into each of them, right? My general comments when it comes to FAANGs is that if you look at their results, Q4 results, I would say most of them, right, is not doing very well. Okay, say for example, like let's say like Meta, Apple, we still see that their revenue is not doing that well. And then for companies like Amazon, you can see that they are still stuck with all this, like cost issue, and they are still coming to like improve their efficiency and so on. Even for Meta also, they talk about efficiency a lot, meaning that they want to cut costs. And all these data points on all this commentary, you can actually tie it back to the like they're laying off their employees and try to reduce their cost structure and so on, right? All these actually, if you just connect all these data points, they are all painting to the same direction, which is that they all want to, make their earnings looks better, but not necessarily trying to boost up their revenues. So the kind of revenue growth that we have seen in the past, let's say 5 years, right? I don't think that will repeat, at least in the near future. Near future is 1 to 2 years. So definitely, if you just read the transcript of all these big tech, right, actually we can feel that the recession is actually here. It is not like it will be coming, it's already here. That's why you can see that the revenue already down and so on. So I think all this will hit the corporate earnings, at least for the FAANG companies. But whether on the S&P 500 level, whether it will affect the broad market, that one I think maybe not so, because outside of FAANGs, you still have other companies, say for example like energy sector, they're still doing very well, right? So those will average out and might even average up to a positive numbers, means that S&P 500 revenue and earnings could still go up, right? So I won't be surprised, but at least if we just like go into all these big tech, their result isn't that good. We can go into more details. I mean, I don't know whether you guys, let's go into some details, just the headline, and then see whether if you guys have any questions, you can post it into Slido, and we can go into that now. Say, for example, you look at, this is the numbers from Alphabet or Google. You look at the top line growth, right? It's only like, 1%. So 75 to 76, basically flat revenue. But this flat revenue, you need to pay attention to Google's, is that, I think, can we see? Yeah, I think this is the part. You can see that when they break down into the segments, right? Actually, Google Cloud is the segment that they still try to grow a lot. And that's because they try to, price their offering at a more competitive pricing, because they are small relative to Azure and AWS, right? So when it comes to pricing, they are more aggressive, and hence they are still trying to grow Google Clouds. And that's why if you look at the operating income, actually Google Cloud, like they are still break even, like, they are not making a lot of money here. So this is considered, as of now, still considered the low margin business. Of course, once it grow to large enough size, of course, they can be less aggressive when it comes to pricing. Of course, it could turn to be a more profitable segment. But as of now, this is the low growth, low margin business. But this one still grow from 5.5 billion to 7.3 billion, means that actually the high margin business, say for example, their YouTube ads and their advertising, all, like came down, from 61 billion to 59. YouTube from 8.6 to 7.9, meaning the high margin business came down, but the low margin business came out a little bit. That's why they're still flat. So this is Google business. So it's not a good picture, right? At least we compare like year on year. Then similar to Google, which is Meta or Facebook, right? You can see that their revenue actually came down, like 32. This is the 2022. We're talking about the last the Q4 quarter. Actually came down. And if you look at their costs and expenses, actually it came up. Of course, if you read the details, or the transcript, there are a lot of things that's happening in Q4. For example, there's some restructuring. Maybe they are paying some severance package and so on. There are one-off things that hit into the cost, and the result is so bad. But of course, if you just look at the top line, if the top line isn't growing, and the cost base is increasing, so it's not a good picture when you look at the income from operation. This is the operating income. Actually, it dropped by half. If you just look at the headline numbers, it's not good. If you factor in all the one-off things, of course, it is less bad, but still not the kind of good that we're seeing in the past, let's say 1 year, right? If you just pull out, let's say Q4 last year and look at the numbers, it's a lot better. It's like maybe there's some leverage effect there, meaning that their revenue growing faster than their costs. So you can see that the operating income went up a lot faster, right? So these are during the good time. During the bad time, this is the kind of result that we're seeing, where operating income just dropped by 50%. Like year ended, like full year ended, also dropped by 38%. So this is not like one quarter kind of things. This is really like we are seeing some significant drop in their numbers. And based on the earnings guidance or their message, right, these things is not going to be improved in 1 or 2 quarters. So if if the situation is good, probably by end of this year or next year, we can see some recovery. But at least that's the guidance that the management is giving now. Okay, now goes to Apple. Apple also dropped. You see the headline 104.96. But in terms of what kind of message that they are giving for Apples, right? I think there are a couple of things that worth mentioning. I think they always quote about, okay, because of COVID-19, there's some macroeconomic headwinds. I think that's true. And for specifically for Apple, I think if you remember Q4, there's some production issue because in China they still have all this lockdown issue, and then they can't came up with they can't came up with enough supply and inventory for the iPhone 14 Pro and iPhone 14 Pro Max. So that one hit their sales in Q4, and some of those sales, right, it will, you know, if people buy the phones not in Q4, meaning that they bought it in, let's say, like January or February. So I think some of that sales will get pushed into Q1, and they mentioned about it. So we can expect to see that the Q1 numbers should be better than last year. So that's something good about it. But I think the few things that they mentioned are one is the COVID-19 that resulted in macroeconomic headwinds, and then secondly is about FX. So for those who don't know about accounting much, just for your information, FX, right, is that they always report in USD. So for those business, if they have revenue globally, so if they sell, let's say, iPhones in China, in other countries, let's say in Europe, once they sell the iPhones, they record the revenue in, let's say, Euro or in Chinese yuan, they have to convert back to USD. So when converted back to USD, if USD is very strong, right, so they have to, you know, record a slower growth because now in USD you are earning less. So all this will hit into their financial statements as well. And this one for specific for Q4, it hit their results quite a fair bit now. So you see here, they mentioned that you know, nearly 800 basis point, meaning 8% drop just because of the FX headwind. So I think they got hit on that. So that's why their numbers isn't that good now. But when it comes to margin, I think margin they're still doing quite well because iPhone 14 and iPhone 14 Pro and Pro Max, they actually lower down the specs of the 14 without the Pro one. So you are getting an older chip and so on. Just push more people to buy the 14 Pro and Pro Max, right? So that one helped them with the margin because more people are buying the more expensive iPhone. So I think that's good from margin perspective. But overall, if you just look at the operating income, you know, it dropped from 41 to 36. This is definitely not that good. But when it comes to Apple, is that, you know, when you look at operating number of 36 billion in one quarter, and just for your information, you can't just multiply by 4 because Q4 is always their good quarter because they launch iPhones in that quarters. But still, if you look at, you know, like 30 billion of operating income in a year, we are talking about, you know, like 100 billions of income. That's really still a huge number. I think this one, every time I look at the number, it's still like, wow, cannot believe how can the companies earn like 100 billions? You could look at some companies, they don't even have 100 billion market cap, meaning that Apple, if they want, they can buy over the companies, you know. Like this is the kind of money that they earn. That's why they are worth 3 trillion market cap, right? It's because of like the strong earnings. And out of those earnings, actually, they if you look at their share buyback amount, it's really still a big buyback. They've been returning cash to their shareholders. So I think that helped out to support their share price as well. But I mean, come back to this is that, again, not a good picture. Okay, Amazon. For Amazon, I suggest don't look at their earnings slides. Straight away go to their Apple earnings release. So this is the report. So if you open up, right, this is the first page. Actually, if you want to read their details, there's a lot of details in here. At least you can get the picture of what they are doing. Sometimes they even talk about what are the new launches, what are the new customer that they get on board and so on. So there's a lot of stories that they are telling here. But if you want to look at their segments, right, I think this is just scroll down and you can see their segments. I think this one is good enough if we just look at here. So in terms of their sales, right, I think sales, they are doing okay for Amazon. So, you know, like 82 billions of e-commerce of America grew to 93. International dropped a bit. I think this one affected by the war and so on. Like macroeconomics in Europe isn't doing that well. For AWS, of course, they are still growing, but I think the key talking points for AWS is that now their growth rate actually has slowed down to 20%, and they're guiding for mid-teens, meaning about 15% moving forward. I think this one is a very, very drastic slowdown in terms of the AWS growth. So I think this is, of course, something that you know, investor don't want to see, because if you look at their operating income, right, actually, as of now, because of all the issues they are facing, right, for example, they actually ramp up their facility, and they ramp up their logistics so much that they have a hard time to monetize all these hard assets they have that they have. So if you look at the operating income, actually they are not really like making money as of now. And you look at the international, which is mostly, I think, Europe, right? So not mostly, it's like biggest one is Europe. They are also not making money. The only one that is making money as of now is AWS. And because of so, if you look at look at Amazon as a whole, right? I would say that most of the market cap can be attributed to AWS. Then the question is, given that they are making, like, let's say 5 billion a quarter, let's say 20 billion a year, right? How much valuation will you assign to that 20 billion operating income? The question is always go back to, like, how much can they grow? If this segment can grow at, let's say, 50%, right? Of course, you can apply, let's say, like a 50 or 60 PE, and just take 60 times the 20 billions operating income and come up with, let's say, 1 trillion market cap for AWS alone. Right? So if they are growing at 50%, but the thing is, this growth has actually slowed down quite a fair bit. So if you slow down to, let's say, like now 20%, how much PE can you assign? Let's say if you are being generous and just assign, let's say, a 25 or 30 PE, right? 30 times 20 is about, let's say, 600 billion market cap. And I think Amazon current market cap is how much? I haven't paid attention to the most recent numbers. I believe it's above 1 trillion. So you take that 600 billion away from the current market cap. Those are the market cap that you can attribute to the e-commerce business, which is not making money at the moment. So do you want to pay so much for this segment? So it really depends on how much outlook that you can give. Like, can they really improve their margins for the e-commerce business? So, and how soon they can do it, right? So these are the questions mark that we can like ask ourselves. But of course, come back to this is that if AWS revenue slow down, also you need to ask, like, whether this slowdown is kind of like structural kind of slowdown, or is it like a cyclical one, meaning that comes to 15%, can they go back up to 20-25% again? So that's also another question mark, right? So a lot of question mark, I would say. But at least in terms of their guidance, I would say that they still try to paint a positive picture. Say, for example, I think they talk about, like, okay, I think also mentioned in Telegram group chat, right? I think Andy Jesse still mentioned about, like, okay, when it comes to cloud, the penetration is only like 5 to 10%. Still a lot of room to grow. I think that's still true. But remember that they have to compete with Azure as well, which is not small anymore. So I think all these things, you can read the transcript and just get a sense of the type of questions that I just posed just now. So I think that's a high level on Amazon's. Well, I've been talking so much. I'll just stop here first. I know, like, let's say, like, typical Singaporean, are you still here? Maybe you lock up already. Anyone else want to comment on any of the big techs, or you want me to comment on any specific topics or not? I can go into more details. Okay, now come back to these questions. Talk about, okay, seems like Apple, Tesla, Google, Microsoft, many others all designing their own chips and ask TSMC to make. Will it affect NVDA, AMD in the long term? I think long-term wise is not a problem, because okay, you need to differentiate all this. Apple, Tesla, Google, Microsoft. I would say that Apple, you should group Apple with NVIDIA and AMD. The reason is because currently Apple, NVIDIA, AMD, these are TSMC big customer. So for Apple, is for the iPhone, Mac chip, M1 chip, all these chips, right? So essentially, actually, Apple is a semicon company. They design chip, right? It's the same as NVIDIA and AMD. It's just that they are all selling different type of chips. For Apple, mostly these are ARM chips for iPad, iPhone, Mac, and so on. For NVIDIA, I think these are, like the GPU, gaming chips, and also for the data center chips, right? So this is NVIDIA. And for AMD, I think mostly these are the x86 chip that's competing with Intel, and they also have the segment for GPU, which is competing with NVIDIA. And maybe there are other type of chip, but I think these two are the main one. That's why I think these are like in one category. And then come to Google, Microsoft, and Tesla. Yes, I think, say for example, like Tesla, they're doing the dojo things, and I believe they are getting TSMC to help them with the manufacturing. And for Google, I believe their Tensor chip and so on, also they are getting TSMC. For Microsoft, I'm not too sure whether they are using Samsung or TSMC. I believe it's Samsung, but I don't remember for sure. But I think for Tesla, Google, Microsoft, these are the segments that they are still very small. So it won't be big enough to take up the capacity of TSMC. I don't think that's big as of now. And I don't expect it to be that big over, let's say, 1 or 2 years. Of course, this segment for them getting bigger and bigger, let's say for Microsoft, they want to design their chip for, let's say, Azure or AWS. Also, AWS have Graviton chip, right? So you can put them into the same category as well. But I don't think these are, like in the volume that's big enough to say, okay, they need to, it will affect NVIDIA, AMD, and so on over the long term. Because if you say they are affecting them over the long term, then I can also argue that between NVIDIA and AMD, also they are sharing all this capacity, right? So they also need to compete for all this capacity. So I don't think that's a big issue in terms of like compete for the capacity that TSMC have. Anyway, they are all like sharing information with regards to how much growth that they are expecting with TSMC. So for sure, TSMC they will like talk to each of these customer and then try to gauge what kind of orders in the future. And then if required, they will expand. They will build new fabs, and then they will order the equipment and they will set up and they will have the capacity. So I don't think that's a big issue if there's more customer on board to them. This is not something. This is not a concern. Yeah, I'll just stop here, just to say that I don't see a concern for now, because whatever they plan to do, it's not like sudden one. It's not like now Tesla just out of nowhere just come out with big order and they take up the capacity away from NVIDIA. It's not like that one. It's more like, okay, even at the chip design stage, they already start to talk to TSMC, and maybe they can talk to Samsung as well, see who can come up with a good pricing. And then as they progress with the chip design and so on, and then all this fab, they have to coordinate in terms of like, okay, by the time you can pass me the design, then I will just manufacture for you. So there's a lot of coordination between all these fabless companies with TSMC and with, let's say, Samsung and others, right? So they can plan all these things in the future. So it shouldn't be an impact. I would say that as more customer on board, it's actually better, because some of this manufacturing R&D, you just do R&D once, you can actually spread out the cost to more customer, right? So there's economy of scale there. So actually, if more customer on board, and then I think that's a good thing for every customer, so they can spread all these costs. That's why when all these companies, when they compete with Intel, actually it's very hard for Intel to compete with them. It's because Intel, they only serve themselves, and now they have the IDM 2.0. They try to do similar things as the foundry model, but in the past it's very difficult because they can't spread out all this R&D. They have to absorb the R&D 100%, right? I mean, before they go to IDM 2.0. That's why I think this is the one good thing about the pure play foundry model. Okay, I'll stop here. Just stop me. Let's say if you want me to like comment on anything, or you have any comment, right? Just let me know. Okay, next one. Are we at the start of the new bull run? What's your view? This is the favorite questions. I think always like this one. Let's say I can tell you, right? Let's say after the fact, Say for example, we just fast forward 9 months later, right? Or 6 months later, you can always look back, right? Whether the rally that we're seeing now is a bull trap, meaning that we are going to get a U-turn back down, right? Or whether this one become a sustainable kind of rally, right? It will become clear after the facts. Meaning that let's say, let's say for example, like March 2020, market bottom already. Of course, after the fact it's bottom already, it seems that everyone can say that, oh, you can pinpoint to that date and say, oh, actually Fed do something about it and so on, right? And announce the QE. Hence, it's so clear that that date is the market bottom. And same as of now, if we fast forward, if really this is a sustainable rally, you can always say that, oh, you see, Fed already talked about disinflations and so on. So of course, this is a bull run, new bull run, right? But of course, if you go U-turn again, go back down, of course, I'm sure you can find out some news talking about, oh, suddenly job growth is so high, and then inflation's shoot up, and then everyone worry about even more rate hikes in the future, and hence market drop, right? So after the fact of things are always clear. But now, as of now, if you just look at it, I can tell you that actually no one has a clue on whether this is a new bull run or not. Everyone is just telling their story and try to pick the data points that fit their story and tell story. So the question to you is that when you ask these questions, you want me to tell story, or you want me to give like the stuff that is really helpful for you to navigate your portfolio or not? If it is helpful one, I can tell you that actually no one. Yeah, just as plain as that. No one know. We are all guessing here. So it's a probability things, right? It could be, yes, it could be that it's a new bull run, or it could be wrong. It could be a bull trap, but no one know. We are playing with probability here. So back to my portfolio, I can share with you that I'm actually like not eager or not FOMO to buy in. The reason is also because I haven't been selling. Say, for example, if let's say 3 months ago, let's say in December, everyone is like so bearish, and I say, let's just sell 50,000, just tune down a bit and buy it back at a cheaper price, right? If I did that, if I just sold in December and market just rally by 10%, right? I'll be panicking already. I need to super, like worry on whether I should FOMO back in. If I don't FOMO back in, what is going to that 50,000, right? So I'll be very worried if I sold. But the stuff of investing, or the stuff that I've been talking, like, now I can count in years already, is that let's just don't position it tactically for short term. Just you have money, you dollar cost averaging. If you dollar cost averaging, which I have been doing in the past, let's say, I don't know, so long already. So meaning that in the past 3 months, I've been buying, even at some of the stocks that we all talk about so long, right? I've been buying, and that means I've been like having some purchase that is way below the current price, right? And I didn't sell, right? Even I sell, I also like straight away move to another companies that I'm more bullish on. So in a way, if I now keep, let's say, a couple of $1,000 as cash now, just to see if really market U-turn, at least I can buy later, right? So I'm okay. If it continue to rally forward, I'm also okay, because I haven't sell, right? So I still have a decent amount of exposure in the market. So market goes up, I'm happy. Market come back down, I'm also okay. So I think I can sleep well, just to let's put it that way. Whether it's new bull run or not, I don't really care. Actually, if we continue to rally upward like this, also quite not happy about it, as in I can't buy it at a good valuation, right? So I mean the discount window kind of short, so I also not so excited about it. If it came down, I am more excited. Yeah. So that's my view on this. Anyone want to comment? Just stop me.
Hello, Buchi.
Yes.
Jay here. Can hear me, huh?
Yes, can hear.
Okay, maybe I just share my views lah. I think it's quite tough to determine whether current rally is a bull run. Without going too much into the technical the TA portion, charts are looking bullish at the moment. But then if we were to take a step back, I think the macro it's still quite weak. There are still some headwinds. So some of the questions that I will ask myself would be, yes, inflation has sort of dropped from like 9 to 7%, but then will the inflation become stickier at this point? Will it be easy for this 7% to drop to 2%, which what the Fed wants? Will the effort be the same as what the Fed has done? Like, 9 to 7, it seems like quite easy. So from 7 to 2, I think the question I ask myself is it as easy as the previous round? And also, we don't know whether will inflation just stage a comeback. So say, for example, the next CPI or the next 2 CPI, there's this slight increase, and then the market may just panic and then start selling off again. So point is, I think there are still a number of macro headwinds. Therefore, it's really tough to see to ascertain whether currently the rally is a new bull run or not, though technical charts are looking bullish. So I think as long-term investor, maybe try not to have a permanent mindset that currently it's for sure it's a bull run or a bear run. Yeah, just do what you have been doing, say for example DCA. For me, because I'm also like a long-term investor, so I think okay, so I will have like two. I'll try to put myself in the bears and the bulls shoes. So if let's say I am bears, right, I will ask myself, okay, I feel the market will still tank. So I will have to ask myself, what backup plan do I have if let's say I am wrong? If let's say this is the start of the bull run and then you rally all the way to end of the year or next year, then what's my backup plan? What am I going to do with the cash on standby? So maybe I, as a bear, I have to have contingency plan. Say for example, say SPY right now is I think more than 410, right? Then maybe I would set the price target. If it hits say maybe 430 or and above, then I may accept that, oh, this is really a bull run. Yeah, that's what I feel. If let's say I am then sorry, still on bear. So if let's say it dropped below 400, it pull back below 400, maybe 390s, maybe I should start dipping my toes in. So in case this is indeed a full bull run and then the pullback is just a very slight pullback, then at least I have still like maybe 20% of my cash already pumped in when SPY is like maybe at sub 400s, and then I can still ride the bull run. So that's for the bear thesis lah. And if I am a bull, I will look out for retracement, because right now I feel the run up is really way too fierce. That's the only downside I feel. So if I am a bull, I will wait for pullbacks here and there, and then as usual deploy my cash in on and off along the way, and then hopefully ride the bull run if let's say this is the new bull rally. Because if you really look at the charts, there are days whereby Tesla pull back like 6-7% during January period, during this rally. And also I think Apple and Google also pull back like more than 2% for like 1-2 consecutive days kind. Yeah, that's all. Sorry, look up sometime.
No, thanks a lot for the comment. I think really you cover the part that I didn't mention, which is the inflation, the macro, all the like how do you steer the portfolio? Like how do you balance the, let's say if you have certain view, you also need to have a cut loss in terms of like view and not be stubborn about it, right? I think these are definitely good executions. I definitely agree with you. Yeah, I can further comment on the inflation part. I think just remember this, the current rally, right? There are a couple of reasons, of course. One is there's a little bit of squeeze there. I believe probably, let's say like there's some short sellers that have been positioning, shorting the stocks, and suddenly you have a rally, you also don't want to get burned, right? So some of these short sellers, they might close their positions. So this one, there's a bit of squeeze happening. And also because there's this disinflations that Jerome Powell mentioned quite a number of times in his videos, in his speech, and you can watch the video FOMC meetings. So I think all this is like, okay, now market is already pricing in certain level of disinflation, and this one is expected to continue down, meaning that if the inflation, not talking about like just going up again, right? If they just stubbornly high, I think market also will be reacting negatively. The reason is that even if you keep the Fed fund rate at current level for long enough, let's say you have to keep it at current level to let's say next year, right? I think it still be very painful for the stock market, because the cost of capital is higher than what people expect. Because cost of capital is not just today's rate, it's also include the future rate as well. Like for example, those who, let's say if you take on margin, you say, okay, I'm take on margin, but for me it's okay to take on margin now because interest rate, although it's high now, but I know that inflation is going to come down, Fed is going to pivot down, and hence I'm okay to continue to take on like a negative spread at the moment. But if these things is longer than you expect, meaning that they have to suffer this negative spread for longer, so they have to sustain the loss, right? So I think that one actually will affect the overall cost of capital, and it affect it for longer period of times is really bad for the capital markets. So I think this one is something to be mindful. It's just that you need to compare what you have in mind or your expectation versus the market expectation. And the thing now is that market really expect that the inflation to cool off. So once they expect that, if that doesn't happen, so just be prepared to see some correction back down. So because once it's correcting back down again, I believe all these short sellers that jump out, right? They might jump back in again, and then that's why you can see a very big like a spike out and then just came back down quickly. So all this really can happen. We are just like 1 or 2 data point of bad inflation from going back down again. So it's a shake. It's going up too sharply, but it's still shaky. I don't see this is a sustainable rally as of now. So that's my comment on that. But whether I want to bet that it will come down for sure, that is not a bet that I want to make. If I have that bet, right, then I have to, at least buy a put options or sell like 10,000 or 20,000 of my shares and wait it come down and then buy back again, right? This kind of things, this kind of like market timing, right? So I'm not ready to do that. I don't have intention. I think for long-term investment, just hold on to it and be patient. That's the right way to do, and it helps with the sleep. Trust me on that. All right, next questions. Been watching LVMH. Wow, this one I need to pronounce it correctly. MS? I think I try to pronounce it correctly. Dior stocks, but they keep climbing and climbing. Are they too expensive right now? Okay, I have to say sorry. I haven't been paying attention to this. If you want to have discussion on these topics, you have to go to the Telegram group and talk to our dear friend. I think he's keep changing his name. I think for now, I think he's using SC, right? So you can have good discussion there with him there. But I've not been paying too much attention here. Yeah. So no comment from me. I don't know about others. Anyone want to comment on this to help out a bit here? Okay, no. I have to pass. This is very specific and niche area. It's a luxury segment. So luxury segment, I believe they have their own economics as well. But at least, let's say, standing outside, I believe you can bet like, oh, now, China opening up, people are traveling again. Once they travel, they will buy all these, luxury handbags and so on. You can bet on that. I don't think that's a bad thing to do, but it's not something that I've been watching, so I better don't comment too much. Later, suddenly just realize these are, like super overpriced now, and I didn't even know about it, right? So I haven't been paying too much attention. It's a pass for me. Next one. Chanos just said in a down cycle or bear market, we are probably expecting closer to 9 to 14x forward PE on S&P. It's now 19x. So you can buy S&P. That's the things, right? So if you believe that the current drawdown that we are experiencing is something similar to like recession kind of things, recession scenario, right? Meaning that you are comparing against 2009, maybe 2016, then maybe 2013, 2003, 2011, this kind of like really recessions period. Then of course you should like, okay, if it is really a recession, of course you shouldn't buy now. You should wait for a forward PE of, let's say, like 9 to 14. Okay. And then of course at that level, right? If it is recession at that level, if you buy and hold it for long term, I can almost assure you that this one you can get a good return, because the 9 to 14 forward PE, that forward earnings itself is already at a depressed level. And if that level you just apply a 9 to 14 XPE, you actually buy it at a very attractive valuation. But that is providing that we are at that level of recession. If you do that, you can wait. Of course, nothing wrong with that, right? I think there are friends in Telegram group that also mentioned that, oh, actually it's still pricey now, valuation still high. You look at the 4P, it isn't cheap, right? I do agree on that. Definitely current level is not like very cheap. But the thing is, if you have a very low, say you draw a line there, say, okay, this is my, let's say call it 14 XPE, and I do think that forward earnings is going to go down, then you adjust down further, you draw a line there, you say, okay, I'm only buy at this level. I just say that if you buy at that level, your future return is going to be good. The thing that we cannot be, like assure you is that whether the price can drop to that level or not. Because forward PE, you're expecting it to go down doesn't mean that you are 100% in your prediction, right? What if the forward PE suddenly just continue to go up and market just don't have a kind of sell off to the level of 14 XPE? What if it stop at 16 PE and just rebound there and then you just miss it, right? So are you okay to miss it for a couple of years, right? So that's the type of question that you should ask now. If you want to have a guaranteed high return, you should set your buying price as low as possible, but you are running the risk of not able to catch it, or you say, oh, I'm not going to do that. I want to minimize my risk of not able to catch it, so I just buy it now first. So you are just buying at a higher forward PE, and hence you are buying at higher valuations. Higher valuation means that your future return is going to be lower. So this is the balance that every one of us need to make, right? But I do think that this one shouldn't be a binary. You shouldn't like draw a line to say that now I'm 100% cash and I'm 100% stocks once it hits that level. So I don't think that is a good approach. To me, a good approach is either you go DCA across time, keep your investing simple. Don't like keep on timing, look at all these things. Just do a DCA program and then you just like live your life, right? I think that should be the default. And if you want to like try to time it or call it like try to buy it at a certain level, you also should do a staggered one. Say for example, like, okay, what is current forward PE now? If it dropped to 12, if it dropped to 16, how much you're going to buy? 15, how much you're going to buy? 14, you're going to buy. So that at least if there's some drawdown, you buy a little bit, and if draw down more, you buy more. And if rebound, at least you can catch a certain portion. Even if not 100%, you catch like certain percentage, right? It could be like 30% or 50%, or up to you, right? So I think that should be the way, lah. Don't draw a line that say, okay, that's the level that you go all in and become a binary thing. So yeah. But come back to this, right? You also need to be mindful that Jim Chanos, he's short sellers. He's happy for short selling stocks. These people's, right? If you just listen to their commentary is like, it sounds like someone from a perma bear. Every time they comment is like market is going to for a meltdown. Even during market lows, right? They still coming with a very negative outlook because they are short sellers. Similar to those who are long-term perma bull, right? Every time you ask them, even market at its peak, right? You ask them, they can still tell you that actually market is still going to go up. So I think you need to be mindful on the peoples, whether they are like perma bull or perma bear or not. I would say avoid listening too much to both perma bull and perma bear. Try to listen to those who are willing to change their mind according to their the market, or according to their insights. So that's one thing. And those who keep on changing their story also you want to avoid. I will include Chicken Genius in this case, actually, because he's used to be very like a big bull on Tesla, and now suddenly become a big bear on the entire markets, right? But he's changing his story because when the market is having a bull run, the story is everything about how good is Tesla, right? So everything is Tesla, good company. Suddenly when he become a bear, now he changed his story to talk about macro, talk about liquidity. When someone who just changed the story, right, I would say that it's very hard to follow, because should I listening to your individual company's insight, or should I listening to your macro? And you just started to talk about macro. I can't even know that are you expert in macro things or not. or no. So I think these are the things to be mindful. I think if you follow someone, you need to know that, okay, this person, is he a perma bull, perma bear? What is his focus? Is he focusing on individual stocks or not? Is he focusing on macro? Is someone talking about macro for, like years, right? At least you can be assured that, okay, he has some experience in looking at macros. At least when it comes to macro topics, I can take some insights now. And of course, don't just listen to one paper. You can, triangulate with like 3 or 5 data points and try to make the assessment yourself. So I think that should be the approach. I try to, like look at different and don't suck up into like, like Chim Chanos. Because if you listen to him, let's say if you watch on YouTube, YouTube might recommend you another perma bear, and then in your world, in your worldview, suddenly it's like, oh, everything is going to melt down, earnings is going to crash. What they call it, like earnings compression. I mean, this is what kind of naming is this, right? Earnings drops, just call it earnings drop. When people give you some fancy name, like call it earnings compression, right? Meaning that they are trying to sound like more clever than they are. So be careful when you capture all these fancy terms. All this is like newly invented things lah. So there's no such naming one. Yeah, I'll stop here first. If not later, people say I flame others too much. I'll stop here. The questions still can buy or not. I would say if you do a DCA, just continue. Don't listening too much on others lah. Just stick it consistent to your strategy. That's the way to go. Okay, last one. Why was Apple up despite missing earnings? Seems like earnings expectation doesn't matter nowadays. I think this one you have to go into the details. If you just look at the headlines, you will miss a lot of things. That's why, I mean, if earning is so easy, right? We just look at this page, then it's done, right? It shouldn't be like that one. It should be that you look at this page, and then you look at things that you find interesting, then you go and read the details. But here, there's no details here. If you open up 10K, maybe there's more explanation in the items. But at least I would say, at the minimum basis, you should at least look at the earnings transcript and just read through it. I think because earnings transcript is like conversations, right? So analysts will ask questions and then they will comment. I think some of these comments is very interesting one. Say, for example, back to Apple, right? I think just like I commented already. If you look at the headlines, it's like, wow, earnings drop, so worried. But now they're telling you that actually there's demand. It's just that we have some problem with the manufacturing. We can't come up with the inventory to sell. So some of the sales actually pushed back to January. So that's why Q4 numbers is a lot worse than they expected. Of course, that's the case, right? So I think that one helped us assure that, okay, even though we are looking at Q4 numbers isn't that good, at least there's a explanation that to tell us that this deterioration is not a structural deterioration. It's something specific to Q4 that only affect Q4. So next year, if they can come up with, manufacturing side, if no problem, they shouldn't have this kind of problem. So I think that's one. Secondly, they mentioned about like FX, these kind of things. If you remove the FX effect, actually the result isn't that bad. So I think these are the things that you can pay attention to. I think other than that, right, I think these are the main one. Service side, they are still doing okay. They still grow the services. And when talk about services, they mention about how many installed base, and their installed base is currently at 2 billion, meaning that there are 2 billion, like all these devices, right? So if they come up with services and so on, they try to monetize it. Say, for example, like I'm using iPhone and I subscribe to, let's say, like Spotify. When I pay Spotify, 30% goes to Apple's. I think this one is really tied to how many installed base, right? And all this installed base is still increasing. All this is good for them. And these are like, businesses that doesn't require you to come up with new product and compete with other competitors, right? These are, like we call it recurring in nature, so it's more stable in nature. So people looking at all this, they're happy, right? So I think for Apple, and when it comes to operating expense, you can see that they are control their costs in a very disciplined manner. That's why they have all these cash flow that they use to buy back their shares. What else? Okay, when they talk about China, also they say that they are not going to guide January or Q1 numbers, but at least when they see that before the China reopening versus the reopening, which is like second half of the Q4, right? Meaning towards December, they've seen some improvement there. So I think they give this kind of comment, and then based on the comment, you can just have an expectation to see that, okay, how good is the overall business. It's not just like Q4 numbers alone. It's more about the message. It's all about like overall basis. Are they doing good or not? I think there are a lot of data points that you can look at to have a sense of whether the business is good or bad. Yeah. So I would say that that's Apple. Actually, for Meta, right? I would say that when I read the transcript, right, you see I highlighted the entire this section. This is actually in the beginning when Mark Zuckerberg gave his commentary in terms of their result and so on. Actually, when I read this, right, I think that it's a lot better compared to the previous quarter. They really shows that, okay, they are getting into efficiency. They cut their costs, and then they have some good result when it comes to their recommendation engine and so on. So in terms of their strategy, in terms of their direction, everything, I do see that direction wise is really there's a significant improvement there. But if you track their numbers, I believe their numbers will not be good, at least for another couple of quarters, because there's still some headwinds that they are still facing as of now. Say, for example, like advertising spend is still going down because I think we're talking about recession. These are really, we have seen some deterioration. So advertising dollars just came down. I think just the top line revenue isn't that good. I think we have to be aware of that. But as a company, they want to build like a good technology company. They are investing for the short term, which is all the AI stuff, and longer term, which is the metaverse. I think all of this, there are some, significant improvement there. So I think last 1 or 2 quarters I've read their transcript. To me, it's like after I read it, it's a lot like I don't know what they are doing there. It's like they are talking about this and that, like there's no clear direction. It's like the management don't know what they're doing. I get that kind of feel in the past few quarters. But this quarter, I do see that there's a stronger direction. Like they know, like that they found their way, and they are navigating out of the difficulty that they're facing in the past 1 year. Let's put it that way. So you can see that all this, like they are making updates and so on. And then when we talk about Reels also, it's improving, although they are not monetizing that a lot. But when it comes to engagement, everything, I think there's a healthy sign there. Just read up. I'll say just read up. Is all the good stuff there. And of course, when it comes to their daily active users, I think if you go back to about 1 year ago, they're talking about whether the monthly active user or daily active user, whether they peak already and going down. There's all these concerns right now. You can see that they are growing again. So I think there's some good picture there. That's why if you read into the details, you can see that, okay, I can understand why the share price went up after that. This is, I just read this like during the weekend. So I think there are definitely good picture there now. Okay, this one is not so meta related. I think this is more NVIDIA related. A lot of trends that we are seeing here, we are using larger model, which require more computation. We have shifted the models from being more CPU based to being GPU based. I think these are definitely good for those who are investing in NVIDIA. I think just more business for NVIDIA. But yeah, I think this one also worth to mention. So I think there's these questions, right? I think the analysts ask them like, okay, why in the past you haven't been focusing so much on efficiency, and now you're talking about efficiency, right? Efficiency, I think the opposite is that they're focusing on growth. So if you are focusing on growth, you don't care so much about cost and so on. You just grow and grow and grow, right? But now they seems to take a step back in terms of the growth and see how much they can, optimize the process, the workflow, everything. Try to be more lean about it and try to cut costs if they can, and try to cut down the capex if they can. So this is the efficiency theme that they are talking about, and this is the start of it. They will go through this in the coming 2, 3, 4 quarters. We don't know, right? But at least this is a theme that they are kicking off now. And the analysts ask them like, why are you doing this now, and why haven't you paid so much attention to efficiency in the past? Then Mark, he answered that actually, in the past 18 years, right, they are growing at 20-30% compound growth rate. So because they are able to grow at that rate, they've been focusing a lot on growth. And when it comes to 2022, the revenue actually went negative. So this is the first year that they are facing negative growth, which is in 2022. And he said that it's a pretty big step down here. And that's why now there's like change of the focus. Instead of like just focusing on growth and growth and growth, now they go into like, okay, can we actually make our organization become leaner, like be more efficient and so on. So I think this is something worth to mention, is that I think in the future, let's say whenever people talk about like, wow, if you buy Meta means that you buy growth stock, I think you just need to be aware that actually Meta, it is not a growth company anymore. They are already at a matured state, and the good thing is that they are still like making money, and how much they can make, it's not like they peak in terms of how much money they can make. If they can streamline it, they can add values to the advertiser, add values and make the engagement higher. Even their user count stay relatively the same. I think revenues, they can still grow, but it's not going to be like a 20-30% kind of growth in the future. I think that's something that we all need to be mindful. And if we invest in Meta, I think you need to pay attention to that now. But whether they are able to grow their profit or not, I think this one really depends on how good are they at cutting their costs, making add more values to the customer in terms of engagement, and increase the ROI for their advertisers. And all these things, right? This is not easy things. This is not like I launch one new product, then I suddenly just set, right? It's not like that. It's all about all the detailed executions, fine-tuning here and there to add values and so on. So if you invest in Meta, I would say that you need to be like, have some confidence on the management to do that. Similar to, let's say like Amazon, right? They're also talking about like cutting costs for some time already, but still, I would say, in terms of traction, I definitely, as an investor, I hope that I hope that they should improve that sooner. But of course, all this is not like, okay, you flip a switch, then it's done. It's not like that. It's all about like all the money, like all the details, executions, stuff that they are doing in their business, the day-to-day things, like they have all these managers. Can they really pull that off or not? So that's something to follow on. I'll close the call here. Thanks a lot for joining. See you guys in the next one. Okay, bye-bye.